Sold at 560.
785 the first, 785 the second, be sure, 785 the third, final time, sold. The third and final time at £910,000, sold. Well, hello again. My name's George Walker. This is the latest edition of the Allsop Prop Chat, in which two auctioneers, Richard Adamson and George Walker, give you our latest views on the market, a little bit of review on last year and how we think it's going to be for next year. All feedback, as always, is always welcome to podcasts@allsop.co.uk. So, a strange year, but the auction world just keeps ticking along. So, in summary, a couple of sentences last year, Richard. How was it for you in the residential market?
Need more than a couple of sentences, I think. But how was it? I mean, you mentioned, or have mentioned before, a bit of a roller coaster. I think it's probably a theme that we've said for the past 4 years when you think of COVID and all the things that we've been through. But last year was extraordinary, really. It started off with a very big auction in February off the back of, a new government, Liz Truss, people doing nothing up to Christmas time. And then we got to February and it felt like people were ready to start spending money and to sell.
Yeah, went mad, didn't it?
Yeah, and those that weren't selling at the back end of the year, understandably back then, were deciding to sell early in the year, which is probably had a much of a bigger catalogue. And then interest rates started creeping up, and that had a massive impact. And you and I were talking before this, obviously, about it all, but if you look at the interest rates, the actual rates that resi buyers were borrowing at, say in February, March last year, compared to what they were borrowing at or being offered at the end of this year, there's not much difference because of the predictions of them creeping up.
It's interesting, isn't it? And on our market, on the commercial side, so we're selling just income-producing investments largely, it did feel like we had a stranglehold on the market almost all the way through the year as these rates were going up. But now, if you look ahead, the SONIA rate, which is what most commercial lending is based on, if you look to sort of, I think it's January, February 26, the prediction is it'll come down to 3%, which is a really big shift from middle of this year when it was still talking 6, 7. So, and your residential lenders were a bit quicker to cut than the commercial ones.
Yeah, they were. And certainly we felt it in November and December that there started to feel like a bit more confidence out there from those that are raising debt. Not just that, but those that aren't raising debt are still influenced by the wider market and the lending markets as to what yields they should expect and what they should pay for things. And there were buyers that weren't in the market in the middle of the year that were waiting to see what happened, were starting to return in November, December. And I'd like to think that's going to continue the first 2 quarters of this year.
Yeah, and something actually I picked up, and I talked with Mark earlier, the middle of the year saw a peak savings rate for national savings, which is the default bank lending basically, of 6.2% for a year fixed. Now, that attracted, I think, 225,000 accounts and was closed in 5 weeks because it was probably a signal of the peak. And Mark did actually say he got an account, but lucky him. But ever since then, that is the point at which our buyers who are buying a Boots or an industrial estate or a roadside scheme, are they paying 5, 6, 7, 8%? Well, if they can get 6.2% for a year, that absolutely stymies their appetite for a lot of them. Clearly, you can't add value to a savings account, but you'd have to do much with it.
Yeah.
So that was a challenge, and I think that is why we saw probably at the end of the year a bit more improved confidence from buyers.
Going back to your point, I would agree with that, but I think from a resi perspective, when you try to rationalise everything, which can be dangerous in itself, is that comparing a bank rate or what you're getting on a return here and now is one thing. When you get the opportunity to add value or the market's change, it's slightly different. So it depends on how long you're going to be in the market for. In resi, though, we really did see last year in particular so much more attention being paid to not just a yield, but the net yields. I'm talking about granular stuff, flats and houses, because it was really important to people because they weren't seeing any capital growth. So they wouldn't tolerate a poor quality yield because they're going to get capital growth because they're not getting it. And equally, they're borrowing at higher rates. That needs to make sense. So we saw a real, it was a double whammy, a real shift in sentiment and people hedging where property will go. Now, that may well change this year as things are starting to stabilise in terms of what your borrowing rates, and dare we say they may start to come down if the predictions are right.
So taking a basket of, you sold, 1,600 lots, how many of those are income producing?
Gosh.
Because is it 50%, 75%?
I mean, it varies year to year. I don't have the raw data on that, but in terms of, we saw a lot. I don't think I haven't got an answer to that.
Because that's how we measure, obviously, we yield. I just wonder where, 2 points actually to follow that up, build costs and the buy-to-let people. I mean, build costs, they do impact what you do to a degree. in terms of putting a loft extension or wherever else in. Any feeling for what people are saying about build costs?
Build costs, if you speak to our development team, they'll say that they have settled in the past 9 months, probably 12 months, but they've settled at a high rate.
Yeah, that's a challenge.
And that's the trouble. So a bit like interest rates, at least they've settled, and it's when they start to come down, and maybe there's a little bit coming off them. They're still much higher than they were 18 months, 2 years ago. And I think, again, the development sectors, which we get to sell at auction, which is always going to be the sub £4 million for development sites. And
it's going to be, dare I say, subprime.
Yeah. It is. Yeah, it is. But that sector's been really hit. It's been a two-pronged attack, really. Well, three-pronged attack, if you think about it, because their borrowing costs have gone up a lot. Their GDVs are stagnant at best, if not were at that time perhaps falling.
Yep.
And the borrowing costs are up. Their GDVs are unstable. And their build costs are very high. So those are the three main variables and drivers in any kind of development appraisal. So there's still a market for that, but it's incredibly sensitive, and it's certainly come off more than any other sector.
Now, I want to cover the sellers, because we've got a bit of a shift in sellers. But has that 3-point attack on that market brought distressed and receivership type of assets forward in any greater numbers?
No, it's a good question, and I get asked that all the time. Are we seeing the floodgates opening and all the the news stories that you see? We do measure the profiles and year on year as to who we're selling for, and it's been pretty static. So, for instance, receivers and administrators last year represented around about 12% of the volume in our catalogue.
I mean, in our market, it's sub 5%.
Yeah,
it's quite interesting, isn't it? But clearly, no one says I'm a distressed seller, but they've got reasons for selling.
But I think there's several reasons for that. Obviously, a large proportion of these banks have signed up to the charter to be fair to customers and give resi owner-occupiers, and I suppose to an extent buy-to-letters, a longer period of time, mortgage holidays, which has caught on since COVID. So, and rightly so, in my view. And that's given, some would say it's kicking the can down the road, but it's given some people more time to get into position to pay things back and to get into a stable state.
I think that's a very similar trait in our markets, because if you've got a portfolio of 20 million quid's worth of income-producing assets like most of our buyers have, the leases are typically 5 years plus. The finance arrangements are typically 3 or 4, 5 year fixed. So therefore, there's no knee-jerk needed for most of this stock. Yes, the banks start getting jumpy, but banks have extended any renewal terms quite a long time, and this has slowed down any anxiety. And with rates coming down, it must just do the job that we're not going to have a floodgate. You say actually in your document, what didn't happen, and there was a lot of talk at the beginning of the year, and I was one of them, said that resi values are going to tumble, but they haven't tumbled; they've slowed. But interesting. What are your thoughts on that?
There's so many variables that influence how the resi market performs, and it also, it performs very differently in different areas and different pockets to it. But oversimplifying it is that there is population's increasing. House building's been incredibly slow for decades, but in particular the past 4 years since COVID. So you've got a lack of stock. That's pushing up rents. So that's helping out buy-to-let investors that may have been struggling.
Yep. And
when their interest rates have gone up in a short period of time, they've been benefiting for a long period of time with rental increases to cover that. So I think that's been masking some of that. But that's, without simplifying it too much, is one of the fundamentals, is that whether it's owner occupation or renting, we have a complete lack of stock and an increasing population in the country. Yeah. So that's very different to the commercial markets, where buyer behaviours and people's behaviours and businesses change over time, and space required is different. But in resi, people need somewhere to live.
And interesting, I get so frustrated with the chat from the government about the stopping the boats and immigration. 500,000 people come in this country every year. Where are they going to live? I mean, it's a great reason to buy resi, isn't it?
And like I say, we shouldn't, to labour the point, is that the level of development of new build properties in this country for a long, long time has nowhere near met what's required. And it's been slowed down even more since COVID for obvious reasons. So,
talk about slowing down. We've covered this a little bit before, and you mentioned again that the buy-to-let investors had, yes, rising rates, but quite a strong growth. And if you talk to any sort of 25, 35-year-old in London, of which I've got two in my family, the rental market is really cripplingly strong in growth. Has there been a flood of the buy-to-let investors throwing their hands up in horror, or are they just being patient and they're accommodating the sort of bureaucracy and changes and sort of regulation?
Well, the buy-to-let market has changed. Some would say death by a thousand cuts, but there's a lot of people out there who still invest in resi property, and as they should, and they do very well out of it. But the buy-to-let market generally has had some real hurdles and things thrown in front of it over the past 5 years in terms of tapered relief on your rents and whatnot, and EPC requirements and various different restrictions and whatnot. So it's not like it's happened overnight. So there will be some out there over the past few years who have seen that, not liked it as an investment model, and then moved on. But no, it's still a very, very popular investment source of people, which is buy-to-lets. Yeah. They have, as you say, benefited over a long period of time of rising rents at quite a rapid pace, particularly recently. And historically, there's capital growth. Now, where there is differences is that, and we've mentioned it before, maybe too much, is this flight to quality. I know you see it and we see it, but when you look at the document we released on Monday, the outlook, and actually looking backwards at some of the yields, because of the increase in interest rates, yields have increased, but they've increased proportionally far more in some of the poorer areas and the lower value areas in comparison to London and some of the home counties and commuter main cities.
Yeah. That's because people inherently trust real estate. And I would say that, we could talk about the biggest change in my market, but I'd say that at the end of last year, we saw this, what I call old money. People that we've known, and they've known all sorts for several generations, are thinking, hang on, I'm not going to pass that one up. That's a nice piece of real estate, and I just want to buy it. And I think that's the old school money coming forward is really, it's a sign of where perhaps the market is.
So, George, there's been lots of changes in the resi market, which we've touched on already, but what's been the biggest change in your market to date from the past 12 months?
Looking at the last 12 months, it was pretty rocky. I mentioned this peak of saving rates is over 6% in the middle of the year. At the end of the year, we've had this strangulation with rising rates and yields have shifted out. Not in every sector. If you take the flight to quality story, the convenience stores are still better than 7%. That may be because we're selling for Tesco's and Farm Foods last year, although Farm Foods are not convenience stores strictly, they're small supermarkets. But the better stock has held it. But rates have moved out, there's no question. And to get some of the tertiary over-rented retail stock sold, you're talking double-digit yields plus. But I felt that the two big things came out of last year, the rising number of buyers at the end of the year. And why was that? I think that everyone would like to predict the bottom of the market, but I think what's happened, the truth is that a lot of our stock, 10, 15% is from funds, another 10% from REITs. They have valuers. The valuers value with a rearview mirror. And until they've got evidence at these increased yields, they can't drop the valuations. And I think from the middle of the year, the valuations started to, this was feeding through. Obviously, we feed this into our valuation team after every auction, but the wider market was accepting that is not 7%, it's 9%. And that's where we find a buyer base. And that became more evidence from September onwards. And in October, interestingly, our average lot size was £1 million for every lot. Now, that hasn't been reached for 3 or 4 years. And that was because these valuer-driven sellers were able to sell. So we're talking funds, we're talking REITs, etc. And that generated lots of demand. When you have these bigger and better quality assets brought forward, our buyers are very switched onto it. They're very cute and they see it, they're ready to go. So perhaps a big fund couldn't quite make that work, maybe because it's deepest, darkest Wales, maybe because it's not close to where the fund manager lives. They can get on side, really work these assets and make some great returns. And that's the biggest change.
So if in doubt, blame last year on the valuers.
You could blame a lot of what I do.
That's the league behind.
I think, but credit to the valuers and credit to the clients was, okay, my values have gone up. So actually they've accepted it and that's now feeding through and that will create a market. Richard, you and I live in a market. You just mentioned your phone's gone 7 times in the last 20 minutes because people want to buy stock. And when you get the pricing right, we've banged on about it before, haven't we? You meet a market, we've got a lot of money out there. And I think I mentioned one of the biggest changes in the buyer pools at the end of last year was the old school money coming forward. Mm-hmm. I'm repeating myself. But it was very encouraging, actually. It's always encouraging. So, Richard, we've waffled on, haven't even talked about the bare numbers. What are your figures looking like in terms of volume and pounds, shillings and pence to 23 compared to 22? What was the shift? Yeah,
it's peculiar really when you look back at what we've been through and what we've just touched on and talked about is that, 2022 calendar year, we were just over 1,000 lots sold, 1,016, and this year just gone is 600 lots more than that have been sold.
That's a 60% increase.
Yeah, which doesn't make...
No wonder your team are looking a bit ragged.
Yes, they are.
Are those numbers predicted to continue?
That crystal ball gazing is dangerous, but I think so, yes. But I think what the important point to point out, and you were talking about the profiles of your buyers, so just rattling through that quickly. Last year, 50% of our sellers were private investors or property companies. So they regularly sell year in, year out, trade, buy, sell. 12% receivers, housing associations and council 14%, and trusts and funds represented 22%. So it's not a massive shift in what that would be year on year. But what they've got some things in common, these sellers, although they're very, very different entities.
Well, you talk about very different sellers there.
Yeah, so there is, exactly. It's a wide selection of people that are selling, often selling for the same reasons. One, they need to sell come what may, irrespective of what the market is doing.
Music to an auctioneer's ears.
Yeah, quite. And a lot of those profiles as well would have been to varying degrees impacted on interest rate rises. They will have debt, they will have needs to service things. Developers and housing associations have got new built buildings with cladding and they want to spend money on that. So they've got these reasons to sell. So they will follow the market no matter what it's doing, which is, the holy grail for us. So that hasn't changed. But those sellers make up a catalogue most years, and we've had a big increase there. There have been some sellers with portfolios that want to break them up and funds and whatnot and break them up, and will be led by the market. I don't see that changing in the next 12 months, but, I've made predictions before and gotten wholly wrong.
So the buyers should make sure they've got enough cash in the bank because there's going to be some
They do, and I think there'll be buyers like there have been in the past that will probably regret not buying in the back end of last year.
Yeah, absolutely, and I'm with you there. In terms of, your Warren Buffett moment, be greedy when others are fearful, or be fearful when others are greedy. What would you buy for the long term as it stands now? You had £5 million. Which bit of your market would you jump into?
I think it always depends on what any individual's appetite for risk is, and mine's probably minimal. But I think I would never steer personally away from a flight to quality. You've got to provide in resi, the location is so key in my view. There'll be loads of people out there that have made money.
So the assumption is driving long-term value.
Well,
you don't want
it's more the security of that. Is
Yeah.
if you're buying residential property in areas that people want to live in, whether it's owner occupation or renting, you're on the right track.
Yeah.
Okay, because you're going to be able to let it, you're going to be able to sell it on, you're going to be able to potentially add capital, get capital growth on it. So for me, it would be well-located properties, whether it's houses rather than, some good located flats as well. And then there's the market for HMOs in good locations and well-done HMOs that are compliant.
Everyone looks at HMO as a big hassle. Is there a way of really sorting this out and getting a system in place that you can actually understand your costs and outgoings and get the returns more positive?
Yeah, you get all sorts of different quality of HMOs. You get some real poor quality ones that I imagine are, very expensive to run, high voids. But you also get some really good quality ones that are built well, get reasonably good tenants, and rents are high. So people in HMOs in good locations are reasonably good tenants at times. So I think that's key, is the location is right, the good quality of them all. There are a lot of operators now that housing associations, some of the government bodies will take out five-year leases on them.
Yeah.
And that, again, is the most secure thing you can get. You've got a 5-year lease, they pay the rent come what may.
You are a classic Allsop partner, a little bit conservative, but a safety. So get it to the council for 5 years, they pay a little bit of a subpar rent, but you're going to get the rent every quarter.
Exactly. I think that was me. That's where I'd go. What about you, George? The big question. If you had some money to spend, what would you spend it on and why?
Well, I think that the re-rating of long income, we were selling and the market was paying 8% for 20-year leases last year in some cases. I think that's going to improve quite quickly. There's no question. And if you can park 2-3 million quid into a single asset now, and you're getting 8% return with 5-year kickers, that's pretty positive yield. And if you consider last year, savings was at 6% plus, it's now about sort of 4 and a bit, or just under 5 for a year, but that won't be the same on a 3-year basis. That's a very positive return. I think if I had an office full of people who really understood property, I'd be very tempted by some of very high yields in the retail. Because, you talk to 2 or 3 of our clients who've got a lot of assets, and I'm talking over 100 assets. One's probably got over 1,000 assets. The void rates on retail are right down. Now, retail I would only really have at the moment as an income buy. But if you're buying 9, 10, 11, 12, 13%, that's a tremendous return. If you've got enough of it, you can gear it up. So your cash-on-cash return is very strong. If you, as an investor, you can cope with the income. Now, as a high earner, you don't want more income. You want capital growth. The capital growth, I would therefore stick with a good old-fashioned well-let roadside.
Okay, so that location-wise, educate me, that's going to be what, secondary and tertiary locations?
Yeah, if you're going for sort of teenage type of yields in retail, you're not getting. It's going to be secondary, tertiary locations. But my point is, I think those yields are solid now because I'm listening to clients. Clients are saying the voids, particularly independents. They're paying these rents because they can afford it. The rates adjustments helped. Yes, there's a cost of living crisis, but if you listen to the tenants, the owners of the buildings, they're saying they can let assets.
What sort of occupiers are they? As you said, they're local ones. What are they trading as? Is it?
Well, I think a lot of our clients, I mean, we don't deal with prime retail, so we're not dealing with the Next and the Oasis, that sort of thing. But they're saying that the secondary locations where you have more regional businesses or even independent businesses, the tenants are easier to deal with. And I think that's the point. Straightforward. You haven't got bureaucracy. You haven't got layers of surveyors to deal with. And I think that helps them. Obviously, you can't fill your portfolio with hairdressers. You've got to diversify. But it's a very strong message come through from anybody who's got a lot of retail stock will tell you that the voids are right down. So it's income chance.
Do you think there'll be buyers the big if, as predicted, interest rates are going to come down? It's a matter of when, not if it's going to happen. If that is the case, do you therefore see some buyers that bought last year at some point when the market was very thin, having opportunity to sell then to a market that's getting better and people are paying more keen yields?
I think they could do. You've got to remember though, the market's very, very perfect in many ways, particularly what we do, Richard. It's a digital process. Both your process and ours are digital. Everything's registered. You can see what's been traded and when. You've got to change something to a degree. Take a leasehold, make it a freehold. Take a 5-year or 3-year lease to make it a 10-year lease. Take an open rent review clause to make it an RPI. Do something with the asset, and you might well do because there is a trade. We can't forget the purchase cost, which can be over 6%.
Yeah.
So you've got to get that right. There is some trading going on. I don't think people are getting rich in it, but it's where they've added value or they've bought in bulk. And it's interesting, we're beginning to see buy in bulk, buy wholesale, sell retail, and that will come forward, I think, this year.
But the long and the short of it, from an outsider looking in at your market, is that through one of the most challenging markets in a decade, you've raised £440 million at over 80% success rates. Next year can only be better? Yeah,
I think it's very strong. We're optimistic. You rarely see an optimistic auctioneer, but I think we are because we're reading the tea leaves and they're saying we've got improved number of buyers at the end of the year. Markets getting together on pricing expectations from sellers as well as buyers. It's competition. In September, we had 5 lots with over a dozen buyers chasing it, and those prices we achieved back in September were pre-trust prices. And I did a piece on that because the sellers got the pricing right. So I think this will be a better year without any doubt.
I mean, I know we're running out of time here and I've got so many questions for you, but obviously, as George mentioned at the beginning, both our commercial and residential outlooks and reviews. So looking back was what happened last year, a bit more detail with analysis on yields and prices and all the rest of it's in there, and a little bit of a crystal ball gaze as well from both of us for next year. So do, when it's released on Monday, have a look. But one bit I mentioned in there as well, and I'll get your view on this, is that it could be a year of two halves in as much as first 6 months there's a lot more positivity out there. Are we going to enter into the US election in November, UK election at some point in the second half of the year, if you believe Rishi Sunak? Is that going to be time to sit on your hands and do nothing? Is that what happens always with you guys? Or
if I've got a roadside asset in Chingford, which is 4 or 5 million, and I'm talking to a buyer, he doesn't really worry too much about what Joe Biden's going to do, quite frankly, because they're not in it for now, they're in it for the long term. You're putting 4 or 5 million pounds down, they aren't going to be swayed by these short-term things. I think that the Labour government is so built into our psyche now for the UK in the next 12 months. Pricing in what they're going to do with the economy is going to be interesting, and there'll be several different bets placed. But Labour should be a pro-growth. It should. Everything they talk about is housing, build houses, grow the economy. It's a very, very Tory government they're proposing. I mean, Keir Starmer is so central. So I think it's only too worried. It's the unknown. It is that. Yeah. If the wretched war in Ukraine stopped, it would be a miracle. No one thinks it does. What else? The terrible Israeli crisis. What else can pop up? Because we got quite used to the battle-hardened way of the last 10 years. Just something every 2 years pops up. We don't want, obviously, no one wants another disaster. But barring disasters, I think it'd be a solid year. Yeah. And we're going to have a Labour government. And if Trump gets in, we're all going to have to run for our air raid shelters, I think. But we can't change it, Richard.
Yes. Okay, well, there's lots of positivity for next year.
I think so. And that's the way I look at it. So thank you for your time. As always, feedback to podcasts@allsop.co.uk, or you can simply email Richard or me, george.walker@allsop.co.uk, richard.adamson@allsop.co.uk. We love covering, love to see your feedback, and also hints and tips of what we should cover. We're trying to get some operators in from the commercial side. So if you run a pub business, restaurant business, we'd love to hear from you. And thank you, Richard, for joining in.
Thank you, George. See you next time.